Welcome to the daily update. We'll go over the action in the market for Tuesday, April 22nd, and we'll see how things look for Wednesday, April 23rd. Okay, well, we had a big down day on Monday, had a big up day on Tuesday, got back everything that was lost and even more in Tuesday's session. And it's if you've ever read the book, The Random Walk Down Wall Street, that's pretty much what we're seeing right now. We were looking decidedly negative, and we still are now. But then we have these big up days that seem to fly in, and about 8, 9 hours before the market's getting ready to open, the futures are still up about 1.5%. Things are looking pretty good in Japan. We'll see if that can carry through the night and actually get into Europe, see how that does, and then eventually back to the US session. So yeah, it is it a dead cat bounce? Did it really change anything? Not really. We're still seeing a more defensive market overall, but some of our indicators got worked off a little bit that are looking extreme negative, at least in the short term. Okay, so right at the open, we had a gap higher where we had a gap lower on Monday, had a gap higher on Tuesday, and prices advanced above R1 at 52.27. We got above R2 at 52.96. And then we even got above 5,300. Then that was pretty much losing steam at that pace. Even though we didn't give a lot of that back, prices did decline back below 5,300, went down below R2, and then found some support at 52.50, and then rebounded up off of that to close slightly below R2. So we were up 2.51% on below average volume. That's still what we're seeing. Down days, up days, we see below average volume there. So there's still a lot of folks that are real apprehensive about this whole thing. And we are still negative in the short, intermediate, and long term. That hasn't changed. It's worked off some of these extreme readings, a few of them, but it really hasn't changed the overall climate. And interest rates did come down, so that was somewhat supportive. And inflation seems to be under control for right now. Everything has to do with the TTT, the Trump tariff tiffs. That's what I call it. They probably use tantrum, I think is what somebody else actually calls this as well. So we'll see if we can get 1 or 2 days of good news and see the market go up, and then something else is likely to come out that'll produce bad news. And it's just a really crazy time. We're not really sticking to seasonal patterns necessarily. We're just kind of going with whatever way the tariff news seems to be going right now. So, Treasury Secretary Bessent came out and said that he expects the China tariff situation to de-escalate. Now, when he gave this interview or made this statement, we were already going up before that happened. So, a lot of folks are saying, well, it's what he said, and that made the market go up. Eh, the market was already going up anyway, and the futures were pretty strong even during the night before Tuesday's session. And so to try to put a cause and effect on this, it was kind of backwards this time. The VIX is still above 30, and that's why we're seeing a lot of this real volatility right now, because we uh, get more volatile when we get above 20 with the VIX, and even with the up day, we're still above 30. And on a short-term basis, we do have the rate of change going back 20 periods, which is still short-term. That's still extreme. And the slope oscillator, the momentum oscillators are really having a difficult time right now because they're a little bit slower and it takes some time for them to pick up which way we're actually moving. And it seems like we start moving in one direction and then we have a 1 or 2 days in the opposite direction, and they're kind of confused right now. And that also includes the MACD, a short to somewhat intermediate term oscillator. And we're still far away underneath the 20 period moving average, which is what I use to determine positive or negative. And we're under that right now. That's the boom indicator. And then in the intermediate term, we're still looking extreme negative with the rate of change going back 50 periods, the TTM squeeze. The PMO still giving an extreme negative reading, the Copic curve, and then we're also far away from the 50 period moving average. And we already have some PMO studies. Notice that the oscillator is extreme negative. We have some of the studies that go with the PMO that are looking extreme positive right now. And the 200-day simple moving average has fallen off the list, but we're still looking extreme with the 150 period simple moving average. No change to the overall scenario. This the back and forth between Trump and Powell, that's kind of dominating things. We'll see if that can continue to cool down a little bit. The dollar was up after it's been getting hit hard lately, and interest rates were down. We closed at 4.39% with the 10-year yield, where after Monday we were at 4.41%. We're still extreme negative. When we get under 25, we are extreme negative. We bounced up two notches from 22 to 24, and we're still negative with our trend. And we're still showing a strengthening trend, which means that the ADX is above its moving average. And it's going up. That means the trend is getting stronger. And with the update, the bias is positive, but I'm still keeping the momentum at mixed to negative. We still have a pretty significant negative backdrop. Now, if we have a good day on Wednesday, we'll see if we can change that and maybe turn more positive there. So we didn't have any economic reports that came out in Monday's session. So this is an actual something that I forgot to take away from here. Then every week we get the overbought, oversold composite put out by Simple Advisor, where we had come all the way down to a 7.71, and now we're bouncing up a little bit here. We're at 23.51, still very negative. And sometimes when we get really extreme negative readings like this, that can help produce a bounce. We'll see if there's any more follow through to that. Then the Dow against the smart money flow, and we're seeing a real disconnect here. If you were to look at the Dow, which is the blue line, it's really been coming down. But the green line here, this is the smart money flow index. That's interesting there. I guess I'm not the only one who makes mistakes here. But they're actually in buying, at least according to this chart. Now, other charts that I see don't necessarily suggest that. And this is on the Dow, where I mainly focus on the S&P 500. And then the dollar gauge touches the lowest, okay, since whenever. And we are showing some weakness. Now, it did bounce up a little bit in Tuesday's session, so we're a little bit off of that level. But the dollar has just been really weak, which kind of goes against logic with all this tariff news and these protectionist type policies that the US is trying to put into place. That usually helps a currency go up, not down. And so it's kind of going against what you would normally think would happen. And then consume, and I don't know why they did this. They must have run out of space at IsabelNet and had an extra chart to put in here because we're going to get consumer sentiment on Friday, and consumer confidence will be coming out and all that. But they threw this kind of right in the middle. It's just folks are thinking that there's going to be more inflation going forward, or excuse me, or unemployment going forward. There, in that same report that we had last time, they're also showing an increase in inflation. And then this is a chart that I showed yesterday at the beginning here when I showed the LEI. This was the chart, but then it was included in IsabelNet. In case you missed that, usually we get really concerned when we go below this red line. We did. Typically, what's happened before is we go into a recession. These grayed out areas are a recession. That didn't happen this time, and we're actually coming back above the red line and showing a little bit of an improvement. But now we're rolling over with the latest reading. If we come back down below this red line again, we will look at this and say, okay, maybe a recession might happen this time. Then consensus earnings estimates, they're going down. Now, this is what we typically see, and it's not uncommon to see this, that when an analyst is projecting what earnings will be off into the future, they probably are a little bit more optimistic. They probably pad the numbers a little bit. Well, as it gets closer and closer to that particular earnings, meaning that it's going to be part of the earnings report, then they have a tendency to revise them down. And we're not really out of line here. We are going down with this, but this started back in late 2024 where earnings are still looking positive. Now, this would make you think it's negative. These are earnings estimates. They're still positive, but the estimates are coming down. And we started to see that slow down in late 2024. That's just about the time we started to see the market. It did go on to set a new all-time high in February, but it was a lazy high. It was running out of steam. It's like, an airplane that's going up and it can only go up for so long before it eventually rolls over and starts to come down. That's kind of what we've been seeing here with these earnings estimates. And then foreign holdings in U.S. Treasury securities over 30% here, 32, 33%. And that's part of, now it's legal for them to do that. They're not doing anything illegal, but this is part of what the vulnerability of the U.S. could be, with Japan having about $1 trillion, 700 to 800 billion with China. And if they get angry with us and they start selling these treasury securities, that pushes prices down and interest rates up. So that makes the U.S. a bit vulnerable if those things happen. And sector flows, we're still seeing most of the money going into tech, even though tech is in a downtrend right now and it's been one of the weaker performing areas in 2025. People are thinking, okay, I'm getting it on sale. I'm getting it at a lower price. Well, okay. That's more of the buy the dip type of a thing. But sometimes buying the dip can turn into buying the actual decline. But we still see that's where money, most of the money does go in. And then capital expenditures, where at the beginning of 2025 and in the first couple of months, we were seeing this explosive growth. That this was going up here. So they're spending all this money on AI, and all these companies were making announcements that they're going to be putting all this money into infrastructure and things like that. It's really fallen off lately. And where then you can compare this to core durable goods. These are, it's a 6 month percent change here, but those are bigger types of items, durable, they last longer. And so, like big machines and things like that, that you don't, once you have one of these machines or tools that you use, it tends to stay around for a long time. Where that is still going up right here, but we're seeing the expenditures really coming down. All right, here's the chart. We're like in a roller coaster here. We jumped off here on Monday and then kind of swooped back up. We did see a little bit of follow through. There was some late day buying in Monday that kind of, now we can interpret it as being more positive. It's kind of hard to know that at the time because there's all that time lag from the time the market closes one day till it opens the next to see if we were going to get any follow through. But the futures stayed strong and we got up here above R1. We made it all the way up to R2 and we actually got above 5,300. That's been one of the major areas that have been tested lately. And we did drop down from that area. And instead of continuing to go down, we were able to find a base, go up, come down, and then we closed just a little bit below R2. So we were able to hold on to most of those gains, even though we saw some volatility going on before, from about lunchtime into the close, or just after lunchtime ended. And we are up again in the initial overnight session, about 1.5%, but that could always change. It's just things are looking okay now. But this is looking a little bit better. We see the futures looking good, the cash market looked good, and now the futures are looking good overnight, at least initially. But no real edge here. If anything, we see the red line above the blue line. That means on an intraday basis, value, which is more defensive. This is what the market gets into when they're getting ready to go down, versus the blue area, which is growth. This is the buy low, sell high. These are the Microsofts and the Apple and the Netflix and the Google and things like that. Both did improve, but neither one is really, I mean, the red line's a little bit above the blue line, but we're not really seeing one outpacing the other. And we're not really seeing much of an improvement here. This is the S&P growth to value ratio. We were looking a little better. Now we're not really showing much improvement at this point. So we were up a little bit more with growth, and value's been getting hit hard lately too. That's why you see the red line and the blue line on the previous chart so close to each other. But everything was up. And was this just a relief rally? Was it a dead cat bounce? Are we actually starting something? You've got folks that are so pessimistic about things right now that it's like we've seen this before. We had that huge up day a couple of weeks ago, and that was mainly short covering, and it really didn't lead to anything. And we ended up going down after that. And then it was up a little bit more with the mid caps and also a little bit more. But you can see the left columns over here for mid caps and small caps. Not much of an advantage over here with growth. So we look at our end of day charts, just a little bit of a tick up here with small cap growth to value. We're just not even up to the 200-day moving average with mid cap growth to value. And we're still declining. We ticked up here a little bit with S&P growth to value, but now we're in a downtrend with this ratio of growth versus value. And not much of an improvement here. Looking at the growth versus value ETF, and then we look at discretionary. Now, one thing that I did point out that is still continuing and is probably going to keep going on here is when you look at the equal weight version of discretionary, we just generated a death cross here. And the reason this will probably continue is that we're below both of these lines. As long as we stay below them, these lines will continue to come down. Where staples, they're in a downtrend. The blue line's below the red line, but these have been holding up a bit better. And then we do the ratio between the two where we did see a bit of a tick up, but not a real change in the overall trend of what's happening. And then this is a newer chart too, just to give us some growth versus value type of perspectives. This is the weighted version of the discretionary versus staples, and they're still continuing to be more defensive than the equal weight. And that's a variation of the chart I just showed on the previous slide. That's still going down. We look at tech, which is growth, versus utilities, which is value. That's still going down. And then biotech, which is the growth area of healthcare, and then compare it to the healthcare sector itself. This is bouncing back up a little bit here, but it's still not really establishing an uptrend. And then we look at hotels, things that don't have to have, but are nice to have when you've got the extra money to do it. Maybe you go on a trip, and then compare that with utilities, which is something you do have to have. That ratio continues to decline. And then just looking at the bellwether areas of the US economy, where the semiconductors at best right now are just kind of chopping sideways. The home builders been showing some weakness. They're chopping sideways a bit. Transports underperforming, and maybe this is some kind of a base that we see being built here. And retail, which I'm starting to follow a little bit more in case we do end up going into a recession. I'm seeing a little bit of an improvement here with the regional banks. All right, so we're still above the moving average. Now we're pretty much going flat because we're getting these big up days or big down days and then a big up day, but we're still negative. The red line is above the green line. That means it's a negative trend. In the short term, still barely above the moving average, also in a negative trend. So short and intermediate term are negative. And we still continue to be below average with volume here. You can see the histogram shows everything red. That means the S&P is below its average volume. And then we're still getting high readings here with sentiment. This is like a fear gauge for mutual funds. And we're still above 30 with the VIX. Even though we came down a little bit, we're still looking kind of scared here. We get nervous when we get above 20. We're actually still above 30. This is a new variation chart that I want to show that the VIX not only works for right now, well, there are what they call futures contracts that say, okay, what does the market think volatility is going to be going forward? And we'll see how much we actually get out of this here, where the current reading we're getting is 30.57. We're above 30, but they do expect the volatility to come down. Now, is this a true reading? If we see this going down, this is called the term structure, and these are looking out into the future, which you could take as positive, where since this is going down, that means that they're anticipating less volatility going forward, which would be more positive for the market. But at the same time, this still looks out 30 days from right now, and that's what the market is mainly focused on with the current VIX. So this can change, but typically you would see a decline like what you're seeing here. And then the VIX of the VIX, this tries to measure the shorter term volatility of the VIX. Excuse me, because as the VIX has been coming down now, the volatility of the VIX is also dropping, but still giving a very high reading. And the momentum of the VIX is now down because we're dropping off of these really high readings that we were getting And so the MACD has the momentum is actually declining. And we ticked down a little bit with this fear gauge, and we also ticked down with this other fear gauge. So we did see a little bit of fear coming out of the market, even though it remains elevated. There's another look at valuations here. The S&P, that's in black where we've been under pressure. And as it's been coming down, the valuation has also been coming down because one of the criticisms of the market when we start going down is that it's overvalued. Well, if price starts to fall, and then that's on a ratio basis with earnings that don't change as much, then that makes this red line actually come down. And then this is another thing. For 8 weeks now, the individual investor survey that we look at once a week, they're very extreme negative. Now, I usually go over this in the weekend videos, so this chart's a couple of days outdated, but I wanted to show it anyway, since not all of you watch the weekly video. But they've just been camped down here. Usually we come down, stay a short period of time, and then bounce up out of this. That's not what has been happening this time. And we did go up a little bit here with the equity put call ratio daily chart. We're going up with the 5-day chart, but we're actually ticking down with the 10-day chart. Not sure if that's offering all that much help. And we're still getting a very low reading with volatility risk premium. Then we probably overdid it. It was a pretty solid up day. And so our advanced decline ratio is giving us a very high reading here. And our advanced decline line percent also giving a high reading. Now, if you notice this one, we had a real extreme negative reading just a couple of days ago. And now we're getting an extreme positive reading, both with the percent and with the ratio. This is a really bouncy market right now. This is more the random nature of things, where there's also a non-random part of the market, and that's what we use technical analysis to try to determine trends, and the debate goes back and forth. Is it random? Is it non-random? Yes, it's both at the same time. That's the conclusion that I've reached. And there's people out there that say, oh, technical analysis doesn't work. Well, it does work. They just haven't found a way to have it work the right way. But it takes dedication. It takes a lot of study, and it takes time to figure these things out. But we're going through one of those more random times right now. As you can see, there's gaps up, there's gaps down. We're just kind of chopping all around currently. And we're still seeing a mixed picture here with the advanced decline line. We're above the moving average based on price, below the moving average, even though we improved based on volume. And we're back above zero and going up. So our 10-day advanced decline oscillator that we look at, that's showing some improvement here. We're crossing back above the midpoint with the short-term advanced decline ratio. We're still just, it's really hard to see. We're just barely positive here with the red line. That's more intermediate term. And again, this is a little bit misleading here because we're starting to go up with our 5-day and 10-day moving average of the highs and lows. But it's not that there's new highs being generated. It's more that it's a lack of new lows because we were getting really high readings, which was driving these moving averages down. We're just kind of chopping along sideways here, which because there's fewer new lows, that's helping the moving averages to turn up. And where we had dropped a little bit below this red line with accumulation distribution, now we're just a little bit back above it. We're still negative though with the chicken money flow. So this smart money indicator is positive. This smart money indicator is still negative. Not much of an improvement seeing the big day that we saw. And we're turning back up and just about at the midpoint and trying to cross above the moving average with the Chaikin oscillator. Still negative with the vortex. The red line is above the green line. Still below all the moving averages here with our advanced decline line studies. Seeing a bit of an improvement after getting extreme negative with those stocks in the S&P above their 20-period moving averages. And this isn't quite an oscillator, but we can at least see if something's going to play out. Where we came down and then bounced up and then came down, we are, for right now, setting a higher low here. So maybe this will show some improvement, but we need to see follow through with that. And a little bit of an improvement with the 50 period, 100 period, and 200 period moving average studies. And still seeing a downtrend now, not a bear market. We have to close down 20% from the all-time high set in February for it to be a technically defined bear market, but we are in a downtrend with the blue line below the red line. And after we were extreme negative after Monday, we're working that off with the 20, 50, and turning up a little bit with the 200 period moving averages. We're back to looking extreme positive with the Stochc RSI. And we're just crossing above the midpoint with the Williams percent R, still below the midpoint with the CCI 14, and even a little bit weaker with the CCI 20. So no, you can see these are our short-term touchiest indicators, and they're all mixed up. That's because we're getting all this bouncing around that's going on. Nothing extreme here with the stochastics. We're right about at the midpoint in the short term, a little bit below the midpoint with the intermediate term, still rolling over with the long term, and about at the midpoint there as well. A little bit of an improvement, but still negative with the force index and chopping around right now with the condition of the short-term trend measured by 20 periods. If these lines turn and go back up, that will help it turn more positive. If they continue to fall, that'll be more negative. And the rate of change going back 20 periods, still below this pink line, giving us an extreme negative reading. And we're still in the minus, well, I guess we're in the -1 channel now. We had gone into the -2 channel. So we're still below the midpoint here with our standard deviations chart. And as measured by Trueflation, they have us at 1.38% inflation. And ticking up, it's still negative with the balance of power. We're still dark, deep purple here with the go, no go. That's negative. We're still below the midpoint with the highest high, lowest low value chart. Still looking extreme negative, but improving since we're seeing a lighter shade of red with the TTM squeeze. And still extreme negative in the intermediate term with the rate of change going back 50 periods. That hasn't improved. Still below zero with the ease of movement, even though it ticked up a little bit here. We're coming down as we've been chopping around. That's what the standard deviation measures, is speed, not direction. And we were just screaming to the downside. We are dropping off with that as prices are more or less consolidating for the time being. Where we were negative after Monday with the S&P McClellan oscillator, we're back to looking positive here. So now we're starting to tick up based on price and volume. And you can see just these little tick moves up and down depending on whether we have an up day or a down day. And we did drop negative with the NYSE McClellan oscillator. That's now showing some improvement, turning back up a little bit here with the summation index based on price and volume for the NYSE. Still negative with the Arun. We're kind of flatlining here. And we're negative, though, with the Swindon Trading Oscillator. It continues to decline and going below the midpoint based on price and volume. And these are the momentum oscillators. They're getting all confused, and we're still getting an extreme reading here with the PMO. We're trying to come back up to the moving average based on price. We're still below the moving average here based on volume. This is the extreme reading here. The PMOs that are rising, seeing a little bit of strength there. We are improving with the buy signals, and we're ever so slightly turning up with the PMOs that are above zero. And we've gone from negative to neutral with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR since the dots are underneath. And then the slope oscillator just kind of flatlining, trying to improve. You could say this is positive now because we're going above the moving average. The MACD is a little bit above its moving average, but still giving us a pretty extreme negative reading. So seeing an improvement here with the short-term oscillators and an improvement in the intermediate term, still looking more negative, but trying to turn up with our longer-term oscillators. And the copy curve, you could say that that has now turned over to positive. We've crossed above the red line. We're no longer extreme negative with the Sean trend meter. This is the condition of the intermediate term trend. The lines are still going down. So it's still negative there. And we're still below all the plotted moving averages here that we have. And the longer we stay down here, the more these shorter moving averages produce like a waterfall spaghetti look coming down after them. We're still far away from the 20 period moving average as measured by the boom indicator. We're still far away from the 50, and we're still not far away from the 200, but we are below zero here. And we're above 50 with the money flow, and we're trying to tick back up. We're just barely above 50 with the ultimate oscillator. We're still below the moving average, and the moving average is going down with unbalanced volume. We're still below 50 with the RSI intermediate term based on 14 periods and short term, which is based on 9 periods. And we're turning back and looking more negative now, even though we saw an improvement with the bullish percent index for the S&P. And we're just kind of chopping around, a little bit of an improvement with the NYSE bullish percent index and a little bit of a tick up with the NASDAQ 100 bullish percent index. So to be up as much as we were and to see these charts not really improve all that much, it's not really encouraging. Like we're going to have to see more follow through. And we're coming down, but we don't have the second signal yet with the mass index. I'll explain more what that is if we have one of those. And we're still holding up this 50% retracement level. That's where we came down and we've been bouncing up. And for the time being, we're still above this 38.2% retracement level. And we're still holding up above this S1 pivot point now. So longer term support continues to hold. And of course, with the up day, that makes it even more so. When we watch this, is when we have a down day, is this support area still holding? And even after Monday, they were. And we're looking more doji-ish here, where we have an open and a close just about at the same point with the Heikin Ashi chart. We're still negative with the Renko chart. We're red, that's negative, but pointing up with the Kegi chart, and we're positive with the three-line break chart. So our trending, different ways we look at the trend, those are also giving us mixed signals. And we saw some new X's. Now, I showed this chart after Monday. We saw some new O's. Now we're seeing some new X's. And you can kind of see this where it's like consolidating here. And it seems to be right around the 5,300 level. So that's kind of the area that we're looking at as a tipping point. If we can break above 5,300, that would be more positive. If we break down below 5,300, that's going to turn things more negative. Long term, we're still far away here with the 150 moving average, simple moving average. It's below this green line. We're just a little bit above it here with the 200. And this is just, these are lines that I put on here to just show, okay, are we getting extreme in the long term? And we switch back to being positive in the long term with stocks and commodities where everything is red after Monday. And we're back to long term again with stocks, but everything else with all the different indexes, they continue to be negative. All the sectors ended up being positive. Now, financials, and that's good. We want, even though it's more cyclical, we like the financials to do well. That just means a healthier economy. But discretionary was up. That's a growth area. Communication was up. Tech was up. And then, the staples were up, but they were up least. That's defensive. We want discretionary communication and tech to really do better, but more than just for one day. Because we've seen this over the last few weeks. We've seen days like this where it looks like, okay, maybe we're shifting back a little more positive, and then we lose that really quickly. And a lot of green here. So we did have the euro crossing below 115, but then everything else, which is actually meaning that the dollar was going up. But then we had the NASDAQ going above 15.9, then 16,000, 16.1, 2, 3, 4. A lot of improvement here with the bullish percent crossovers with the tech sector, things that have been really getting hit hard. Discretionary showing some improvement. The NASDAQ showing some improvement. Now, healthcare, which is more defensive, it even saw a little bit of an improvement with the BPI cross above 30. The Dow is still in a downtrend, even though it was up 2.66%. And we've gone from negative to neutral with the Elder's Impulse system for the diamonds. We're still in a downtrend with the NASDAQ, and we're back to being neutral again there with the NASDAQ. Still in a downtrend with the NASDAQ 100 and also going from negative to neutral with the QQQs. Momentum is still hanging on to being positive. We were in danger of crossing below this moving average. Well, Tuesday's session helped us turn back up. So the momentum is still positive there. Still in a downtrend here with the S&P 600 small caps, also in a downtrend with the Russell 2000 small caps, and have gone from negative to positive here with the small caps. They were up 2.59% with the small cap. This is the Russell 2000 ETF, small cap index. Mid caps still in a downtrend as well, going from negative to neutral here with the Elder's Impulse system for the mid caps. The Wilshire still in an overall downtrend, seeing a recent death cross here. And we're also working off of a death cross with the total US stock ETF, but it was up over 2.5%. Financial sector coming back up to its 200-day moving average. It was up 3.33%. And then the FANG index below these lines, the longer we stay down here, the more we might see this turn into a downtrend. And these are the really big stocks: Facebook, Apple, Amazon, Netflix, Google, Nvidia. Apple was up 3.41%, but it's still in a downtrend. Starting to see a death cross here with Amazon. It was up 3.5%. Microsoft in a downtrend was up over 2%. Google in a downtrend up over 2.5%. Meta in a downtrend up almost 3.25%. Nvidia in a downtrend up over 2%. Tesla, which I guess they reported earnings and they were really bad, but the stock's up in after hours trading, but it's in a downtrend as well. And Netflix probably looking about the best here, just about ready to set a new all-time high. So this is one of the better looking stocks right now. And then looking at retail, this is a ratio between the retail part of the market and the SPY, where we are seeing an overall decline. This is just the retail area itself, and then we put an RSI on here, and it's improving, but it's still below 50. When we get above 50, that shows more positive momentum. And seeing a bit of a working off here as US stocks have been going up and bouncing up here. That's the red line. But world stocks have been doing a bit better. And that's why we're seeing the short-term correlation actually coming down. We're leveling off, but still slightly improving with the longer-term correlation between US and world stocks. Oil was up and getting back up into the mid 60s now. We're still in a downtrend with the dollar, even though it bounced up. And we came down here with the 10-year yield. Not much of a change, but that still could be helping stocks. The bond market seems to be a bit more under control for right now. And we came up just a little bit here on a closing basis with the 10-year based on price. No real improvements with our growth to value ratios, still below the moving average with the Qs to S&P. Coming up, it's still below a moving average with discretionary to S&P, and large cap growth is underperforming large cap value. So the large caps still seeing weakness here, mid caps weakness, and small caps weakness. So what's our outlook? We're still negative in the short, intermediate, and long term. That hasn't changed. We will get the MBA mortgage applications. Probably the bigger report is going to be the global manufacturing and services PMIs. And then new home sales, that'll be coming out. And then most of the focus now is what's the current fixation about the tariffs? If it is it positive or is it negative? And then on Thursday, we'll get initial jobless claims and then consumer sentiment on Friday. This is what is expected here. And we'll be watching this. These PMIs, if they're above 50, that shows expansion. If they fall below 50, that shows contraction. Then seasonality, we are dealing with the week after options expiration, and we tend to be up 64% of the time versus being down 36% of the time, going back to 1980, where on a seasonal basis, when we've been just kind of blowing seasonality out of the water, we're positive with the Dow and S&P, neutral to positive with the Nasdaq for April 23rd. And we do see some positive seasonality coming in here. A little bit of weakness here with the green dash line. That's the S&P during a post-election year. So the warning signs, we're still looking more negative, even though we're turning back a little bit positive with accumulation and distribution, but it's really hard to see that. And the chicken money flow and the chicken oscillator, they continue to be negative. We're still negative with the growth to value ratio. That's long term. And okay, something, all right, we got a blank spot there. Momentum trying to improve, but getting jacked all over the place. The bullish percent indexes not really improving that much. The moving average studies are not improving. Ease of movement, ultimate oscillator, and the vortex, they still continue to be negative, and our long-term special K oscillator is still negative. Positive side, discretionary to staples, even though we saw a death cross here with discretionary and the equal weight recently, it's still hanging on to being in an uptrend, but it's clearly negative in the short term. And we're actually looking a little more positive again with the S&P and NYSE McClellan oscillators and summation indexes. I'm having to change this from slide to slide every day. Swindle trading oscillator, I think, wasn't that negative? Okay, I forgot to move that one over. The parabolic SCR is still positive. The money flow, the financial sector, we want that to hold up and do better. And the momentum for the NASDAQ 100. And we're just waiting to see if this mass index thing is going to mean anything. So our conclusion, we're still negative in the short, intermediate, and long term. We're seeing some oversold. We actually have a couple of overbought conditions in the short term as well. And we're also continuing to be negative in the long term. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.